Cold open midnight to 1 o'clock. Imagine a skyscraper built entirely of glass. But you can't see the cracks inside. To the outside world, it looks flawless. But every gust of wind, every tiny earthquake, edges it closer to collapse. This is how modern finance works. The numbers look neat. The balance sheets look safe. But underneath, risk is hiding in plain sight. And when it escapes, it moves faster than anyone expects. Setup, 1 to 3 o'clock. We live in a world obsessed with stability. Banks, governments, investors, they all want to look safe. Yet, time and again, crises arrive out of nowhere. The 2008 meltdown. The dot-com collapse. Even sudden currency crashes in emerging markets. Why? Because financial systems are designed to mask risk, not eliminate it. The mechanisms that make money move smoothly also hide the fragility beneath. And most people, professionals included, never notice until it's too late. Today, we're going to peel back the curtain. We'll see how leverage, debt, and market structures make danger invisible, and why the systems that are supposed to protect us sometimes accelerate collapse. Step 1. The illusion of safety, 3 to 6 o'clock. Start with banks. They borrow short-term money from depositors. They lend long-term loans to businesses and homeowners. On paper, everything balances. Assets equal liabilities. Regulators see neat ratios. Investors see AAA ratings. But here's the trick. Risk doesn't disappear, it just moves sideways. Derivatives, insurance contracts, and off-balance sheet vehicles are like mirrors in a funhouse. They make the financial system appear stable. The exposure exists, but it's fragmented, layered, and mostly invisible. A hedge fund might claim only 2% risk on a portfolio. Reality? If one bet goes wrong, the losses can cascade across banks, insurers, and pension funds. And because the system is interconnected, nobody sees the domino effect until it falls. Step 2. The psychology of ignorance, 6 to 9 o'clock. Humans are part of this illusion too. Investors trust ratings, assume diversification is enough, and rely on models built for the calm, not the storm. Here's a quiet irony. The safer something looks, the riskier it often is. Consider mortgage-backed securities in 2007. Millions of homeowners defaulted, but investors believed the housing market was safe. Complexity disguised danger. Sophistication became a form of blindness. The funny and tragic part? Everyone involved was smart. They just trusted the system more than they questioned it. Step 3. Hidden math, 9 to 12 o'clock. Now let's look at the numbers. Banks report capital ratios like 10% or 12%. That's supposed to be their safety cushion. But those numbers are based on assumptions, probabilities of default, correlations, stress scenarios. Change the assumptions slightly and suddenly 12% turns into 0. Leverage amplifies everything. A bank borrowing 10x its capital can collapse from just a 5% shock. It's not intuition. It's simple multiplication. Yet most investors never see the math behind the curtain. Even more invisible is systemic risk. The danger that one institution failing triggers failures in others. Risk compounds quietly until it reaches a tipping point. Step 4. Hype versus reality, 12 to 1500 hours. Financial markets love stories. Tech stocks are unstoppable. Emerging markets are the next gold rush. Cryptocurrency will replace banks. Hype masks true risk because it shifts focus from numbers to narrative. Reality? Every system has limits. Liquidity dries up. Correlations spike. Confidence evaporates. When the narrative collapses, so does the market. The absurd part is watching people double down on the story even as cracks appear. It's like cheering while the glass skyscraper tilts. Step 5. The bigger picture, 15 to 1800 hours. So why does this matter to you? Even if you're not a trader, these invisible risks touch everything. Interest rates, inflation, pensions, housing prices, even the stability of your savings. Financial systems are highly efficient at creating the illusion of stability. But efficiency often means fragility. Complexity hides danger, and interconnectedness spreads it faster than anyone can track. Governments and central banks can intervene, but only after the problem becomes visible. Prevention is nearly impossible when the risks are designed to be invisible. Conclusion/thought-provoking ending, 18 to 2000 hours. The uncomfortable truth is simple. We live in a system that rewards appearing safe over being safe. Risk doesn't vanish. It only moves where we can't see it. So the next time someone shows you a neat chart, a glowing rating, or a story of perfect growth, ask yourself, what does this system hide? And how long before the cracks show? Because in finance, what you don't see can hurt far more than what you do.